Hello, everyone. I'm Aaron Johnson with the Dwayne Johnson Group and Bridger Financial Services, here with a recap of the fourth quarter of 2023. So 2023 is in the books, and it's been pretty interesting so far this year with plenty of ups and downs. But as we end the year on balance, we saw more ups than we did downs, unlike 2022. The stock market picked up steam in the final quarter of this year as the economy began to slow in response to the Fed's aggressive rate hiking efforts. So let's take a look at the fourth quarter and talk about 2023 as a whole. Markets looked a little frayed at the end of the third quarter, stumbling as interest rates climbed close to levels that we haven't seen in the past couple of decades. By the start of the fourth quarter, we had given up nearly half of our yearly gains, and the overall mood was pretty sour. The decline in inflation had slowed and was actually picking back up, sparking continued fears that the Fed would need to take rates even higher. Then Hamas attacked Israel very early in the fourth quarter, causing concerns that markets that oil supplies might be disrupted if the conflict expanded throughout the region. Despite all of this, the third quarter domestic GDP came in at 5.2%. This was significantly higher than the respectable 2.1% recorded in the second quarter. Meanwhile, consumers continued to spend and the job market remained strong. All these events pointed to the Fed needing to do more. As a result, October lived up to its historical gloomy tradition, but the fever began to break in mid-October after the Treasury yield touched 5%. By that point, the conflict in Israel hadn't spread, so oil prices had stabilized and actually counteractively began to fall. The Fed, which held off on a rate increase at its July and September meetings, wasn't scheduled to meet again until the last day of October. That was a good thing because we avoided any knee-jerk reaction due to uncertainties around the turmoil in the Middle East. Not surprisingly, the Fed did some hedging about one more 25 basis point hike in the future, but it was all talk, and they ended up making no more additional moves in November or December. The consumer price index dropped to 3.2% in October, and it was at 3.1% in November, mostly on the decline in energy prices. Jobs continued to soften, and the consumer began to show signs of weakening. So the table was set for the markets to stage comeback, talk about a soft landing, potentially lower rates, and declining inflation began to make the rounds. This Goldilocks scenario of the Fed backing off and lower energy prices combined with the coming holiday season helped propel markets to levels that we hadn't seen since the end of July. With all of this, we finished a year in a higher note. The S&P was up 20%, and the yield on the 10-year Treasury had dropped from 5% in October to just below 4%. I mentioned the Middle East conflict earlier. We dodged a huge economic bullet there. Since the conflict stayed contained between Israel and Hamas, oil actually declined and gas prices came way down. This matters because when people are spending less on fuel, they tend to buy more of other things. Plus, producers and stores are willing to lower prices because transportation costs are now lower. It has a snowballing effect. The question to ask is, why are oil prices down? The big reason seems to be lower global demand due to slowing economies. And although lower gas prices are great in the short term, prices are not due to excess supply, but more of a lack of demand. The lack of demand is worrisome, but we know how volatile oil can be and how quickly things can change. That was the dynamic in the fourth quarter. Lower oil prices lead to lower inflation, which helped the Fed and took pressure off the consumer. It also made borrowing a little easier. The challenge is to not have things get worse and lead to a recession. Good cheer outpaced negative vibes as we ended the year, but will only be a question of time before the markets decide that bad or weak news is that way for a reason. I was optimistic that we would end 2023 on a positive note, and we did. Overall, 2023 delivered some solid returns as the economy and consumers hung in there. Inflation rates have come down and the Fed has stopped raising rates. Plus, investors had way more options than they did in years as interest rates rose to historical averages. Sure, there are a number of things that we could pick apart as we look back at the fourth quarter and all of 2023, but things were a lot better last year than they were in 2022. So I'll be back in 3 months to recap the start of 2024. We'll also carry some momentum into the first quarter of the new year, but recession and inflation worries are still lingering. We'll have elections and world events to contend with in 2024. All of this will more likely continue to create a volatile environment, which will require discipline and diligence. A risk-focused allocation will also help. This is why we do a lot in the protected side of things. And we don't want to try to overreach. We want to be deliberate and disciplined with the risks that we are taking. I believe 2024 will be a good but volatile year for the markets again. Thank you for your trust and confidence in us. If you have any questions, please give us a call at 951-244-6702. Until next time, have a great start to 2024.